Now I want to take a moment to look at economic development in Latin America. As countries in Latin America became independent from colonial rule, they tried many different strategies to try to develop their country. One of the things that they tried was something called import substitution. Import substitution is a process by which domestic producers provide goods or services that were formerly bought from foreign producers. So the idea was we want our country to develop and become industrialized. So what we should do is quit importing things from other places and try to create these things ourselves and sort of close off our market so we're able to build our infrastructure to be able to do this. So a lot of countries tried these strategies and had some aspects of success, but the difficulty is that your domestic markets then aren't competing on a global scale, so often the products that they produce end up being more expensive and not as efficient as the products that are produced through the rest of the world, so they can't compete once those borders finally come down. So from the 1930s to the 1960s, import substitution was sort of the big economic strategy. Government put a lot of money forward into investing in these new industries, which meant that they often needed to take out loans. This stimulated growth in local industry and created industrialized or working class, but again, it wasn't integrated with the world economy. So through this time and then through the 1960s, these countries borrowed money to be able to sort of support their countries and to develop. And by the 1980s, the global market had essentially a recession, and there was unprecedented debt throughout Latin America. So in Brazil, over $100 billion, in Mexico, over $100 billion. So the 80s was thought of as kind of the lost decade for the economies of Latin America. As a solution, the United States and the IMF came into these countries and tried to extend loans, lend more money, and offer debt forgiveness. One of the ways that they did this was through what was called structural adjustment policies. Now, we talked about different strategies for development earlier on in the quarter, and one of those was neoliberalism. Neoliberalism is the belief in free trade and reduced government. So the idea is reducing the subsidies that government gives to businesses will force businesses to be competitive, and competition will find the most efficient and successful businesses. There's the privatization of formerly public-owned goods, and then removing barriers to trade. So bringing down things like tariffs and quotas. So within that strategy, you have this notion of structural adjustment policies that were introduced by the World Bank in the 1980s. And the goal was to try to increase the exports that were coming out of various countries, so they would have the cash on hand to pay back loans to the World Bank. This was pushed by the United States. Historically, when I've taught this class, the focus has really been on things like structural adjustment policies in Latin America. But with the debt crisis in Europe, with the debt crisis in Europe and the United States, this is something that becomes more and more salient to the rest of the world. So the requirements that the World Bank often put on these countries to be able to receive these loans included removing subsidies to different aspects of producers in their economy, reducing the power of labor unions and workers, so they're able to keep wages low and profits high to be able to keep that money coming in to pay off the debt, to devalue the currency, which often led to problems for folks in terms of their savings and earnings being not as able to purchase things in the marketplace, cutting spending on social services, eliminating barriers to foreign multinational companies to come in and set up shop or to trade, to sell off national assets, to deregulate business, decrease wages, and restrict credit and interest rates for internal borrowers. So this had some positives and some negative results. it tended to reduce inflation and debt in a number of countries, but it also increased food prices because people's money was worth less in terms of its buying power. It reduced government spending on things like healthcare, education, and infrastructure, which had negative effects, especially for poorer folks. It also increased unemployment because the public sector was often cut and people were losing jobs there. And also there would be competition because there aren't these barriers to trade anymore. You'd be competing all of a sudden on the world scale, and local industries sometimes couldn't compete. So the poor were often really hard hit, and you see that in how these policies played out in a lot of parts of Latin America. To delve in a little bit closer and think about to look at a specific country, we can look at the economy in Brazil. Brazil is currently the 6th largest economy in the world. They have well-developed agricultural, mining, manufacturing, and service sectors. So as we talked about the different sectors of the economy earlier in the quarter, you can see their economy is somewhat diversified, so they're not just working in primary production, but also things like manufacturing and services. And GDP per capita is about $10,000 a year. This is the 12-month cumulative exports through April for Brazil, and you see that primary products make up about 40% of that, semi-manufactured products at about 13%, and 45% for manufactured products. If we compare that to other parts of Latin America, we see on this chart the percent of export diversification. And we talked about the different sectors of the economy, and in many places in Latin America, there's what's called primary sector dependence. So this is when the economy's main focus is on primary sector activities. So these are concerned directly with natural resources like agricultural products, minerals, or fish. There's not a lot of value added, and these markets tend to be highly volatile in terms of price, which can be very negative for countries that are so invested in them. So we see some Latin American countries here. The blue are the commodities, and the pink is the sort of manufactured goods. Brazil is the second bar on the chart here, so you can see Brazil has a pretty even split, but places like Chile are more than 80% dependent on commodities, places like Venezuela more than 90%, Peru more than 70%, and so you'll often see that places with more diversified economies have higher levels of income for the folks living in those countries. If we look at economic activity across Brazil, we can see places here where there's production of agricultural goods. So areas in the brown is production of coffee, in the red, cocoa, sugarcane in the green, rice in the orange. We also see mining activity, places that have the sort of red characters denote the different mines, so mining for iron, manganese, coal, etc. throughout Brazil. And then different manufacturing areas that you see with industry, things like food processing, industrial manufacturing, much of that centered along the coast and in the southern part of Brazil, where there's more urban populations to be able to do this work. If we look at then Brazil's map of wealth, the higher incomes map up with the large cities. So around Sao Paulo, incomes from $30,000 to $40,000, and as we get into the more rural areas and into the Amazon, significantly lower incomes, as you can see, state by state. Brazil also has fairly diversified trading relations. So this chart shows trade with the U.S. and Puerto Rico at about 13%, about 21% with Asia, 22% with the European Union, and about 25% with other Latin American and Caribbean countries. it's estimated that Brazil's economy is going to continue to grow. This chart shows expectations of different world economies for the next 40 years or so, and we see this one ranks Brazil as the 9th largest economy, and they're expecting Brazil to become the 4th largest economy in the world after China, India, and the US. So it's really expected to be a booming economy. And just to kind of wrap up, I have a couple pictures then of from that Peter Menzel series from Hungry Planet, looking at different families and what they eat in different countries in Latin America.